Welcome back to the Wirex Podcast. I'm your host, Lianna Adams, and today we're diving into a topic that's critical for AI-driven startups, exit strategies in the AI age. How to position portfolio companies for maximum valuation. To break it all down, I'm joined by someone with deep expertise in scaling and monetizing AI businesses, Sanin Cutuk, Chief Revenue Officer at Workforce AI and Taxaroo. Welcome, Sanin.
Hey, Liana, thank you for having me and looking forward to be here.
Yeah, really excited to have you here. So maybe let's start with your professional background. How do you get to where you are today?
Oh, okay. So I started as a business analyst because that's something that really intrigued me, like even when I was a kid. And quickly I moved into the private equity, being selected by my mentors, and they taught me a lot of this stuff. During this period, I was mostly into the mid-market and growth stage ventures, but also my role was not strictly about deploying capital. It was deeply operational and centered to forge strategic relationships and scaling distribution channels, which is from the perspective of PE very important, because the first thing that we tackle, I'd say, is the operations, and then from there we are trying to understand how to undervalue the company first. That's the policy, one of the policies of PE, and then what are the options to really build in sustainable value creation. So in 2010, I started my independent consultancy, which was part of the entire network, and that really gave me an advantage to get into the roles like a CRO through the perspective and on both sides of like how to streamline revenues and estimate and evaluate acquisition opportunities. And I'd say it's more about building the engine and ensuring it's perceived correctly by the market and potential investors. My early engagement with AI starts, I think, in 2013, maybe 14, when I was introduced by my friend to some of the very interesting AI startups at that time, like Albert AI, which was a marketing platform. I was fascinated with capabilities, and I was always playing with BI tools. Like at the time, I was like super fascinated with Watson analytics and with the Sisense, to whom I also helped to build out some stuff in expanding to market, particularly for the Sisense. Now, the current portfolio we are running is encompassing four AI companies, and I can say proudly this, that we are recognized as the leaders when it comes to the AI for tax and accounting. So we started with the zero tax AI, which was creating the different aspects of questions and strategies on taxes, and this led us to becoming the first specialist on AI technology with a RU, which is integrated with our company Taxaroo. And the recent development since April last year is the Workforce AI, which is agentic, and it's absolutely amazing. I love to play with it a lot. And now we integrated it, I think, in February into the Taxaroo AI. So simultaneously, we are trying to combine the latest technology with the SaaS we have and integrate the entire process so it will make sense.
That's amazing. And, you've seen it all happen, right? From traditional, I guess, traditional way of doing things and, now with AI. Maybe for the sake of some of the audience that may not know, what is PE when you're talking about PE in this context?
Oh, I'm so sorry for the terminology. Yes, that's a private equity part of alternative investments.
Gotcha. I mean, we can't just assume everyone knows what PE is, right?
Yeah, sorry for
um,
that. I'm like
no,
so deep into this. I'm like just throwing the
no,
terms very
you're
quickly.
all good. You're all good. So AI is reshaping industries at an unprecedented pace. How has it changed the traditional exit strategies for startups?
Oh, okay. So I think it didn't only um reshaped I like to say it like tweaking traditional exit, considering M&I or IPO, but it fundamentally rewired them. And to give a background a little bit about this, like in four points, I would say three to 4 points I'm having in mind. Like for example, when it comes to the valuation multipliers, companies are genuinely leveraging AI to create a defensible advantage. So this means that we need to really pay attention to data, unique data sets, proprietary algorithms that can improve KPIs. So it's not something, hey, I'm having chat that can draft the email and stuff. How we are creating the value in terms of operations and it being integrated through the KPIs and entire P&L. And then another thing is that what we are pushing with the Workforce AI through the Taxaroo is hyper personalize the customer experience. So this is really something that can multiply valuation. And acquirers, to be honest, are recently are not just buying the businesses. Even we did have this period, when the funds were investing in big guys like OpenAI, Google, and so on. There was also a huge wave of FOMO, fear of missing opportunity, where they were investing in wrappers. And now all of a sudden, these wrappers didn't play it out in the terms as it been expected. And many VCs, some of them I spoke with, their entire portfolio was about this. So with this being said, I think that they're trying to acquire efficiency engines, because when it comes to the PA portfolio companies, it's all about value creation and structuring the efficiency to the level exit is not going to be that much extremely sort of say leveraged, or they will try to look for the future-proofed market position, which is also an important part of the evaluating the entire portfolio. Secondly, the acquisition rationale. I think the reason for acquisition have been broadened, and by this I mean like by traditional market consolidation or acquiring just customer bases, we now see concept of acqui-hires, which means acquiring the company because of the talent. One of the good example is Google acquiring DeepMind. So it's not about the tech, but also about the expertise and talent that sits in this company. What brought us today to have Gemini and all of these cool features they offers. So I think this is really, really important considering how acquisition can take direction toward where positioning itself, enriching the asset and enriching portfolio, or literally blending in something that will create a better value for the existing company in the portfolio. The other thing, the due diligence intensity, I think, and that this is like what I was taught and was doing. This is one of the most important things. So the diligence process for AI-centric companies is now far more rigor because of the multiple elements. Buyers are trying to scrutinize the actual impact of AI and in its core to value proposition, or just like AI washed. And this is something we've seen recently. Oh, we are using AI. We have an AI, this and that. And the good example of this is that if you go to Google or you just go and search, there is no many of the companies, oh, we are building it with an AI. We are building with this and that. Most of the companies are heading toward the internal upselling and cross-selling. Hey, we just introduced an AI that can draft email for you. Now this AI can do this and that, and so on and so on. So I think that due diligence now contains a deep dive into the data pipelines, because data is still the biggest thing when it comes to the tech. The model's efficiency, scalability, and also one of the extremely, extremely important things. Maybe now we don't talk much about it, but this is going to be one of the crucial things, and it is ethical considerations. And I would also add another thing, defendability of the algorithms. Like we see so many copy pasting, like recent happening, OpenAI and DeepSeek, where people are claiming, okay, DeepSeek was trained on a OpenAI and so on and so forth. But in general, I always try to see like who was the first, and not strictly compare the cost, or they produced the same model or equally competitive model for way much lower amount of expenses and cost versus them. But then we need to observe who started it. And the last thing I'd like is about IPO, or initial public offering. So for the companies eyeing on IPO, the AI narrative is, I think, very, very important. And we see these movements. Like, I think yesterday or day before, I read about the OpenAI raising 40 billion. But even they are not IPO company, still there are the indices how this reflects. For example, the IBM, they are like one of the first coming with this technology. But it also can be double-edged, like I said, because it excites public markets, but it also invites intense scrutiny on sustainable growth and profitability driven by the AI. So these four, I think are really, really key changes, or reconnections or rewiring I see in reshaping the industries.
Yeah, I love that you mentioned IPO because that really leads me to the next question of, many founders see exits as the ultimate goal, right? But should they always be aiming for one? When does an exit make sense versus scaling independently?
Oh, that's amazing. So recently, I'm seeing a lot. Okay, I want to start my thing and then I want to exit. Exit is not necessarily the end game, and I'd say it's an outcome, but it can be a lucrative one, but it shouldn't be the only goal. So I like to, when it comes to the exit, I like to break it down into the couple of points, and I will just pull couple of them. So what's the market opportunity and the dominance? If we have a clear path to dominating the large growing market and strong competitive advantage, potentially AI driven, that can improve the operations. And even now further, when we are talking about the AI agents and stuff, and agentic harmonization of the stuff, and ideally, if we have access to patient capital, which means that funding is secured, I'd say scaling independently will be like tough game. But the first conditions mentioned, personally, I'd go scaling versus exit. And this is something that happened to us. We did receive the offer last September, I think, through November. We did get into the negotiation, and then since we already have seen like very, very fast progress of the Workforce AI, we decided not to. So let's scale it. Let's build really something cool. And the value creation we created by this cool is the solution not only for our customers, but also solution for their customers. And just one quick example before I jump into additional few points. So for example, when you filling in the data or format for preparing the tax preparation, you ask certain questions. And what agent now can help you is that, okay, I need to pull out this information from this and that, and then run the entire process from sending the document to be signed, signed, I don't know, requesting the e-signatures and so on. But it extends further. There is a solution for our customers to help their customers. Sometimes people are old, and if we look, where is the money right now? It's older generations, boomers, millennials, and so on. What happens is that, let's say I'm somebody older and I want to interact with the software empowered with this type of technology, and I don't have, let's say, my driver license to prove the identity or something. So I can go to through the part of the questions, and all of a sudden I found it, and I can say to the agent, "Hey, I just find my license. Can we go back to that question?" And it can fill in the data for you. And this is really, really something that I'm seeing how to get really really good positioning in terms of market opportunity and dominance. The next thing I would add is capital needs. So scaling often requires like huge capital. And even we talk and we hear people, oh, I want to scale, I want to do this, I want to do that. It requires significant observation and understanding of the entire operations. So if the next growth phase demands resources beyond what current investors can provide or what the company can generate, an acquisition by well-restructured player or an IPO might be the most logical path. And I'd say this is the distinguisher. Okay, should I exit or should I continue? And this is where I will pinpoint sort of like, should I build for an exit? Then I will personally see it as like, okay, it's easier to flip the business. Go ahead, buy an app, keep developing it, and then exit. Or should I go and build this because I have a patient capital or I have a sustainable network that can really, really bring me to the market and create the stuff? Another key point is strategic fit and synergies. We recently hear, oh, I applied to VC, they rejected me. I applied to this fund, to that fund, and I've been rejected. So I think that exit makes immense sense when acquire offers not just capital, but also significant strategic advantage. And we also have to observe, let's say as a founders, is the exit the right thing? Can we grow further? Can we make more? What's the conditionally set absolute value we can gain? Not only having the business, but also having the great people in, having the entire scope of the ecosystem and really pushing it forward. And I'd say combining entities should be demonstrably stronger than standalone company. Nowadays, when network and internet and everything enables us to really, really build through the networking and stuff, I strongly believe that being in a part of the strong or even decent network is way much better than building it standalone. Standalone today or building it that way is super hard. And of course, we need to understand our ambitions and risk appetite. So we need to be honest about long-term goals. Do we want to like run a large, potentially public company, or do we want to, I don't know, prospect of integrating into the larger organization? These are like really, really important questions we should all ask ourselves, because I think in general, there is no wrong or right answer, but we should be aware. Am I building, let's say, a company where I'm going to be recognized as a tech leader, AI leader in a tax and accounting industry, or I want to build an AI where I'm going to try to push into the multiple industries and just be, let's say, not mediocre, but less interesting to investors, and then limit some factors for my future growth. And last thing I'd like to add is the timing. So market timing is really, really something that opens and closes. Something like I mentioned, September and through September and November option to like get out or stay. And favorable market conditions are really, really strong in offer present opportunity that's simply too good for a risk-adjusted return perspective. To explain this quickly is like, okay, if we sell company now, what do we get? Of course, we get capital, but we also have other options to go. If we stay now and we integrate the Workforce AI into the Taxaroo, we can increase the value over time. And this value brings in all three elements I mentioned earlier, from the data perspective, how AI is trained on 70,000 pages of the IRS rules and regulations, how it can scope and do tax analysis and research, build the case studies, enable communication, and then satisfy both sides of the market, clients and data clients.
That's really fascinating. And you know what? Like, there's so many things to consider, right? When you want to either scale or to exit. But, I'd also like to think that, most founders would scale and not exit because there's a sense of responsibility to your customers, right? In that sense. But yeah, it's definitely a complex situation, and one, kind of needs to think about the why, right? Um, so how should founders be, thinking about their data strategy to make the company more attractive to buyers or public markets?
That's perfect question. So I think data started playing key roles since internet became popular. Not necessarily, let's say, going back to the Google search versus Alta Vista, but I think one of the not maybe major but cool events appeared showcasing the importance of data, and that was the period of Verizon when they acquired the Yahoo. So Yahoo did have huge problem with the ad blockers, and they were started locking in their account users' accounts if they've noticed that they have ad blockers. This also created a huge position for undervaluation. But from this case, um, I think we all learned the lesson, the value of the data. And regarding this, I want to point like quality and governance over quantity. So it's not just about like having the big data and all of the stuff. It's more about having it clean, structured, well documented, and ethically sourced data. So we can go out there and buy data, but when it comes to especially to an AI, how do you train your data? Based on what? How is data processed? Um, is it something, I don't know, I'm searching whatever, and then the algorithm is fed by the articles and stuff we have on the web, and now we have this poisoned kind of the environment, and it's not strictly related to the hallucinations. It's just that the model is pulling the data from a different sources. So do we want to do that, or do we want to like create a specialist and have our own data that can really give the superpower to our model? Proprietary and unique data, I think this is also a big thing. Now we can discuss like data to be honest, like till end of the year. But I think key question we should ask ourselves: what data do we have that no one else does? Is it a unique user behavior? Is it specific industry process data, or data generated by unique operations? For example, if tax professional or enroll agent or accountant or CPA is running individual taxes, they have an insight into the assets and all of the elements for these individuals. How valuable is this data? But also the ethical question is, can we as a company or vendor provider of the service use this data? If not, then this data is no of value for us, not for our AI. But if there is an option through the different moduling, like enabling free software use with a limited, let's say, features where user compliance with sharing this data with you, this is like, just imagine like enormous competitive advantage over the market. And accessibility and infrastructure, I'd also like to add, where we need to really pay attention what I mentioned earlier for analysis and model training. Like, are we using the publicly available data, which can be biased, which can be poisoned, sort of say, or we are using our internal data to really power up this thing, and demonstrable value of the what we are doing. So crucial thing, I think, is that we need to clearly articulate and demonstrate how our data strategy translates into the tangible business value. So I'm not just talking about data. Okay, we collect the data, we analyze, and we have the historic value. This is what's happening. How this is improving our customer lifetime value. For example, am I trying to use data to predict future outcomes? What are the options to, let's say, reduce the customer acquisition cost? How customer acquisition costs, especially in a SaaS space, can impact operational costs? Can we predict rich churn? And can we enable a new product feature to be powered by an AI? So I'd say that today, data must be directly integrated into the P&L, and especially when it comes to the AI.
Yeah, that's really fascinating. And it kind of brings me back to something that you said before, right? Which was to pay attention to unique data sets. And I feel like, as we move forward with AI, it's really a lot about personalization, right? Like everyone will have their own data sets that they deem important, or, like, and I also draw parallels to the impact space where, you start off with what do you want to measure, right? So therefore, what data sets do you want, out of this initiative or yeah, or a cause? Yes, and given the current AI boom, is there a risk of overvaluation, you think? And how can founders ensure their valuation is grounded in real business fundamentals?
Oh, absolutely. We already see these trends. I don't know, the other day, I don't want to like mention anyone in incorrect way or anything. I forgot what's the name of the company, but they literally bumped their revenues, prospects turning into the actual customers that really blew up their annual revenue and their monthly recurring revenue. These things are happening, especially with the hype of AI. We also have to be realistic of the capabilities of AI. Not everyone is going to see this as an ultimate solution. For example, you have brick and mortar business, and they do like the technology. They do like the concept of the e-commerce. But if you add to it, let's say, an AI feature or layer, is it making more value? No, because it requires more sophisticated automation, not just something to prompt or find a result or information. And most of the businesses already do have like large knowledge bases and stuff. So I don't think it will create in this particular example value. And there is a hype, of course it is. Like I mentioned, when big players got funded by the funds caused by a lot of the dry powder in an industry for the last 3 years, that money needed to be released because of the investor sentiment and literally funds being asked, what are you doing with my money? It's sitting in your account, place it somewhere, do something. Immediately we've seen so many of the AI wrappers that impacted FOMO. So this is something that is happening. And in addition to this, I think the ground valuation in reality, founders must really focus on a couple of aspects to avoid to be seen as a overvaluation type of the startup. And like they have to have a demonstrable ROI of AI. So it's not just talking about the AI features. It's more like quantifying the impact. So can AI reduce the customer acquisition cost? How does it increase lifetime value? How does it improve operational margins? And can we tie AI initiatives directly to the core of financials and operational KPI? We also have to consider unit economics. AI should improve and not only mask weak unit economics. So, for example, many companies at the beginning do have a problem with the profitability, and that's completely normal, and that's nothing wrong with that. but we are trying to mimic it. So particular example I've seen was, oh, this company is getting to break even, but then on the other side, you have an information where the banks which gave the loan actually started selling the debt. So this is a negative implication, but also this shows another side of it. And is it something where AI, for example, can enhance profitability? And now we see the traction of AI doing this for this example. Competitive advantage is another thing which not see it anymore, especially when it comes to the AI. Something temporary, something that will last for let's say a season, something that will last for quarter or maybe even 2-3 years. It's something that we need to build, at least strategically, having documented for the next 5 to 10 years. Yes, we are in fast-paced industry. Everything is changing with an AI and so on and so on. But then at the end, like what's the difference for the end user between all of the LLMs we have right now? Not much. Somebody prefers more the visual. Somebody prefer more like better constructed texts and answers and research and so on. And this is what keeps us like, okay, what's the next step? And everybody talks about the same thing about next step, which is an agentic. So is the AI creating really lasting advantage? That's one of the questions I would always consider, especially right now. Like, which AI is going to give me more? Google versus ChatGPT. Okay, ChatGPT is awesome as a standalone, but then on the other side, Google integrates through the entire ecosystem they offer. And then, is it based on proprietary data, unique algorithms, and is it hard to replicate? That's also something, because we now have to think about defending our business, because nowadays everything can, like, we see people posting on social media and sharing. I just built a website in 1 minute with LLM. Okay, how does this impact on the quality of that website? By after that, seeing some people complaining, I tried it, it failed, like my website got broke, versus somebody actually who will sit down and really build a website the way it should be done. This is just banal, basic example. And is it based on availability of the shelf AI tools that easily uh, competitors easily adopt? This is like the cause why we have, let's say, so many wrappers nowadays. And yes, of course, companies, the foundational model, they need to create money. But then on the other side, we have the conversation we did have earlier: DeepSeek versus ChatGPT. Solving the real business problems, I think, is the most distinctive thing now when it comes to the overvaluation. So the other day I spoke with a couple of friends and we did have discussion about AI this, AI that. And I mean, in not rude intention, I literally told them all of these are right now toys. Like, what are you really solving? How operationally efficient you are with using this? And I asked a couple of them, okay, can you explain to me, do you see any value in terms of operational efficiency? Like, how much time of it saves for you? Can you say that it saved 2 hours, so you can put these 2 hours into something else? And then in monetary value, do you see anything right now or in the future? Everyone gave the same answer. No, for both of the questions. We still have to prompt, we still have to do this, we still have to do that. And then you end up with a tool that we already have with the prefix of an AI. And I think this is really, really important to understand what we want to achieve in terms of building, and how do we really solve the real business problem. And last thing to add to this is transparency. Like, transparency nowadays is really, I'd say, crucial, and we have to be prepared to show, not just tell. Like, hey, I've built an AI that, like, does this and that. Okay, show us. Can we do better? Can we do something? And then the story ends up there. That's really, really important, and we have to allow potential acquirers or investors to really deep dive into our AI works, because plenty of things are going to happen, and we really need to be aware of it. And that's, I think, the healthy relationship between potential investor and the founder. Just one of the examples regarding this recently, I pointed out. So we have the CRM systems and we have these calling features. So we have calling feature that enables, let's say, automation. So it's not auto dialing. It's more like, okay, my agent can keep up calling your list. What happens if this individual that's being called got really mad or disturbed and then calls the communication regulator? You get fined. And for example, in the US, these fines are really ferocious. They're like super high. Do we want to acquire this type of the business on a promise? Yes, my agent can replace SDR. No, it cannot replace an SDR because there is a policy regulation that disables this. But instead of pushing this narrative, we should maybe go toward, okay, it can analyze the calls, it can pull the stressed keywords, it can give more support to your SDRs. So this kind of the transparency really plays key role, I'd say, in this type of the businesses nowadays.
Yeah, which brings me kind of to like AI ethics, right? So with AI ethics and regulatory concerns growing, do these actually pose a threat to exit opportunities, or could they lead to valuation drops at the last minute?
So I think at the given point, it's more valuation drop, but deal killers are going to appear, I think, in a near future. Let's say violating standardization of GDPR, CCPA, demonstrably, I don't know, biased algorithms. I don't know, especially if we are into the industries of fintech and health tech. Let's say, reputational risk is a really massive thing. Valuation erosion, like you said, I think it's already happening. Like, okay, what your AI is doing, what are the capabilities, and we need to really be more rigor and run into the ethical of regulatory issues and discover this stuff early stage of diligence. Also, the integration challenges. Let's not forget that. That's something I'm always saying. If your technology requires me to become an engineer, it's really useless to me. It's not that I'm rejecting to learn new stuff, but I just don't have time to learn new stuff. And should I hire an in-house dev just so I can use your tool? Or I don't know, are you going to charge me an extra to integrate your tool? Or how it's going to happen, how it plays out? Do we have the clear path and so on? And also the future proofing, I'd say, that's something that buyers are strictly looking ahead. And that's where the assessments are really happening a lot regarding the AI practices. And what's the future risk? I'd say also, it's not only, okay, it's all solution for now. What solution can be improved? Can the solution be improved over, let's say, 5-10 years, or is it something temporary? So I'd say founders need to and ethical considerations and compliance into their AI, like right now. Just one example from our experience, when we started training the agents and started collaborating with them, we did have situations where they go loony. So I will ask, I don't know, Jack AI, can you tell me about something? And then, I don't know, Mike AI will start answering. Just banal example. So we came up with the rule, human compliance first. So each time one of the agents is appointed, strictly knows that it's answer, but also in terms of executing, okay, I prepared the report. Do you want me to read it for you? Do you want me to end it to somewhere, and so on?
Wow, that's that's crazy. That's just so insane, right? Just to imagine how it all interconnect, and also, the ease of it as well, right? In data, and yeah, we definitely need to encourage ethical use and also ethical development, of these AI tools. If it's yeah, so if you were advising a founder today, who wants to maximize their company's exit value in the next, 3 to 5 years, what are the top three things they should focus on?
Okay, I can share from our perspective three key focus areas. So integrating AI for demonstrable core business impact. So it's more like, I'd say, don't build AI in silo. Try to deeply integrate it and all of its capabilities to fundamentally improve core business model and key metrics. And this includes revenue margins, efficiency, customer retention, and make it quantifiable. Make it like really part of your business. And that's the element where you will really see all of the aspects I've mentioned earlier. Okay, how it's improved my operational cost. Is it does this make my company more efficient, and so on. I also think, since we are really really bumping into data madness, that we should focus on building the fortress around our data. More and more, we will have a different data and different aspects. Like the previously I mentioned the example. Okay, from this accountant, if I offer for free, let's say, and he complies with the data being accessible to us, what's the value? How much we can do with this? And this strategy really, really must be huge. And let's not forget that AI is full by data. The more qualitative data we have, the more secure it is, the less concerns we will have. And third thing is, I'd say, with an AI, what we have right now, we have to focus on scalability and defensibility, because everything can be copied, everything can be mimicked. We hear people saying, oh, we will lose jobs because AI is going crazy, we will be replaced, and everything. So I'd say simultaneously, we should ensure that AI applications combined with the data or even network effects create really strong and the defensible competitive advantage. So it's not being aware we can be copied, but prevent it to be copied because you have the strong leverage of the data. So I'd say like these three things where AI is a core business element and creates an impact, creating really really secure and strong data, and focus on scalability and defensibility of what we're building.
Yeah, that's so valuable. What's one misconception that about exits in the AI space that you would like to debunk?
Oh, there are many, but I'd say that simply like what I'm hearing right now, I'm having an AI. So what? And everyone thinks like, okay, I have an AI. It's the thing like sparkling AI in their pitch or blurb deck, however we call it. It's enough. No, it's not. Like having an AI it's really like even if you use Microsoft, you use Google, you already have an AI. So why is your business consultancy? Is it really solving the operational problems? How it integrates with everything? And the reality from an investor and acquirer perspective is that AI only is valuable if it's applied effectively to create tangible and defensible business value. Period. Like we've moved past the novelty phase. AI is here for very, very long time. And it's not only about claiming the use. Of course, it differs in the claiming the use, what I mentioned earlier, like the example from Google acquiring DeepMind, where you have acquisition because of the exceptional talent. But also, we have a lot of wrappers where poorly implemented AI or one that doesn't address a core business needs or is not using easily replaceable techniques and data. I mean, it adds like no premium. It's just an AI user or wrapper, and that's, I think, the misconception we are facing every day. Like it's an AI, so what?
In a way, it's kind of like if it's not life changing, forget about it.
I mean, not literally like life changing. I'm hearing
I
you
know.
something like about something. Like, so what?
Yeah, exactly. Are there any predictions on how AI startup exits will evolve in the next decade?
Oh, absolutely. So I think one of the first things I want to see, and that's where we are heading, and this is going to be tough, to be honest, with all of the internal and external data and how data is processed, the quality. So as hype will start settling down, the scrutiny will intensify, and that's what always happens. That's how new things in the market works. So exits will more likely favor companies where AI is deeply integrated and drive the core business value versus those that create a superficial applications. Like, let's just consider I don't know, extension for the Chrome versus the full integration in the Chrome, where everything you are doing, you really have the entire manipulation of the end value of the entire end to end actions taken. I think consolidation is going to be next big thing. So we'll see continued and to some extent accelerated consolidation, both tech and traditional. So this is the always next thing coming, and we are still facing the problem of the let's say traditional and modern, or brick and mortar versus web, and so on. And I think that startups for technology or talent with verification of specific AI expertise and unique data sets are going to stay really competitive. So this is also part of consolidation. What do I want to have? Do I want to have like a super impressive talent, or do I want to have let's say a wrapper which will also require talent, but because it's not that premium, it will not give me, let's say, the larger or expected revenue, and then I will be stuck in between. And this is one of the situations where it ends up, okay, I'm building alone my own thing because for whatever reason, I'm not ready to go in. I'm also expecting AI native valuations. This might be super interesting, where companies built from the ground up around AI different will have different operating models. And this is where what we mentioned earlier, data advantages will come in to play like really huge element into the valuation frameworks. So, for example, if we compare SaaS to this type of the company, this will outperform SaaS like in valuation in incredibly higher multiples. And that's something what we are doing, leveraging two companies to create a higher value. So Taxaroo is not just a SaaS, it's a AI-driven SaaS. And valuation like jumps insanely. But by mentioning this example of AI native companies. And last part, I think AI vertical dominance is something that today is of tomorrow. If you're becoming an expert, let's say in tax and accounting field, that's your domain. That's where you play. And from there, it will be easier to go, let's say, in a project management, let's say into the operations, let's say into the virtual assistants, and so on. But the more you have the foundation ground built in one vertical, uh, the quality of the data, the quality of the model being trained, you will gain huge advantage and position defensibility for the next step in a way much more prominent phase where the next thing should be easier. And I think this is really something I'm seeing as a next coming dominance. And of course, ethics and regulations, that's going to be next I wish we can be faster on regulations and policies and stuff, but unfortunately, for now we will have to creative workarounds and work in between. That's why we have so more D2C kind of the elements from existing big foundational models. And in future, I think there must be solution for this, or we will just jump into the tech that doesn't make sense. And then we will need to have the situations like Microsoft, then you have the internal development, the IBM, then you have the internal development, and so on. So I think these are the core things I'm seeing to happen.
Wow, that's a lot to kind of take in as well, and it's so just so many gems, right? Before we wrap up, Sanin, anything else you'd like to add?
Uh, yeah, I mean, to put in the crucial points is that like building a company for a successful exit in the AI age isn't about I'd say chasing the AI trend itself. It's about building a fundamentally strong, scalable business that strategically leverages AI. So, are we building toys, or we are building something that will really improve the business and entire vertical end? So, can we measure stuff we are doing and how it impacts both us internally and external uh, factors like customers and so on?
That's amazing. And I love that. Are we building toys? Sanin, this has been an insightful discussion on how AI startups can navigate exits strategically. So thank you so much for that.
Hey, thank you for having me. It was my pleasure, and thank you for the opportunity. This was great.
For our listeners, if you found this conversation valuable, don't forget to subscribe to the Wirex Podcast for deep dives into fintech, AI, and the future of digital finance. Thanks for tuning in, and we'll catch you next episode.